Soaring fuel prices may have consumers seeing red at the gas pump, but some oil service companies are seeing nothing but green. Jim Tisch's Loews Corp owns how much Diamond Offshore?
51%.
51. Majority owner of DO. Stock's up nearly 35% since last year. Michael Rothman is Senior Managing Director, Head of Integrated Oil Research at ISI Group. And we'll just continue our discussion, Michael, about whether we actually are going to see some demand destruction down the road. What's ISI's view at this point?
Well, you're actually seeing it. For the way we break up the world is the OECD countries and the non-OECD countries. Most people are not used to that breakdown, but you've had, I think, 9 of the last 10 quarters in the OECD go negative. Been offset or mitigated, really, by growth still in the developing world, but it is happening. In fact, if you're really honest about the numbers, in the last 4 years, you've had to shift your oil demand curve down by almost 4 million barrels a day from what was originally expected.
All right. Is the developed world so much bigger than the undeveloped that if there's demand destruction there, it eventually will take over, or can China and India and other countries just sop up any excess forever?
The belief that's out there is they'll sop it up forever, but the reality is the OECD countries are still about 60% of what's actually consumed. The developing world, the non-OECD, has been the primary source of growth really for the last 15 years. There's not much of a pattern break there, but the rates of change have really slowed pretty dramatically. In fact, there was an article in one of the main papers about 6 or 7 months ago talking about how robust demand was, and really when you look at the numbers, that's hardly the case. The issue that's more pressing right now in the developing world, the non-OECD countries, are these reductions in subsidies that are being talked about in a number of different countries. Our own group that's in Beijing has talked about the prospect that they'll actually cut their subsidies sometime in the foreseeable future. They're not sure when. I think the issue has been more about timing and whether it will be pre or post-Olympics. But the reality is you have seen a number of countries respond pretty significantly to higher average prices.
Wouldn't it be great to be the big producer? And why would you ever cut subsidies when you can, keep prices high and you're producing it, so you're getting paid back on the price, like Russia or something? Why would you ever cut subsidy?
Actually, they did.
Why?
Historically, oil's been their largest source of hard currency generation. It's still, I think, the single largest source of national revenue. So for them, just like even in Saudi Arabia, the push is you have a resource that you're better off selling than using. That's why when President Bush was over in the kingdom, I think 3 weeks ago, one of the lesser-known developments was an agreement that we'll sign an MOU, Memorandum of Understanding, with Saudi to develop nuclear electrical generation capacity, essentially have that free up oil for export.
Mike, let's talk long-term. If you were the king of Saudi Arabia, where would you want oil prices to be today?
When you talk to people from Aramco or the ministry or even SABIC, the answer is not that different than it was 20 years ago, which is the price that won't destroy demand, create alternatives, and still allow an adequate revenue stream. Now, the last number they've talked about is still somewhere around 50, but it's become somewhat theoretical because they haven't had to defend an oil price in almost 4 years. But that is still, even at the March OPEC meeting, the number that was coming up. At the end of the day, the concern that you have right now are not just a slowdown in demand growth, but a shift in the underlying structure of oil demand, and of course the growth in supply, which is a big topic of concern. There's a very emotional and wide range of opinions about the supply response, but it's still fairly significant, including the non-traditional sources of oil.
Are you a peak oiler or not, Mike?
I'm not a peaker. I hear that term, and it's very nice. It sounds easy to talk about. It seems intuitively correct and
scary, and it's got to happen sooner or later. And you can get to so many places if you assume that it's true that are fun to talk about.
But having said that, Pennsylvania, if you looked in the at 1900, Pennsylvania was the country's biggest oil producer. Now we've got none. So peak oil applied to Pennsylvania. And peak oil will, at some point in time, apply to Saudi Arabia and the Middle East.
Right. But the question is...
But when?
Are we there? Yeah. There's a lot of questions. I mean, peak oil, Dan Yergin's probably a better historian to talk about the 5 times that we've lived through peak oil. I've gone through it from the late 70s, early 80s.
Yeah.
And it is a seductive story. I'll give you that. But I tend to tell people to try to remember oil, particularly the supply side of the equation, is more of a cycle phenomena. And many people forgot that oil prices coming into this decade were sitting at $10, and there was a view, a very widely held view, that oil was never, ever going to go over 15. The reality is when prices crash, it caused a fairly significant contraction in the industry, and if you were an upstream guy, if you were looking for oil, whether you did exploration or production or services, your businesses contracted dramatically. The other side of that, excuse me, the other side of that is in 2004, oil's not at $10 or $15, right, and the cycle turned.
They thought it would never go above 15 at the same time we were worried about global cooling, Mike. It was sort of the same period.
Yeah, our market's built around extremes in both directions.
Yeah, exactly. All right.